Hey guys, Sean here. It seems Wall Street is in trouble and the big banks are looking towards massive layoffs to trim off the Fed. Now, if you don't know by now, banking and finance is perhaps the most ruthless industry known to man. They hire and fire people lightning fast and things aren't looking too good right now. We have Goldman Sachs looking to reinstate their year-end job cuts. Why? Apparently, their revenue has fallen by 23% and their Q2 profits have nosedived by 48% down to $2.8 billion. Now, while this is still higher than Wall Street estimates, this profit crash is foreshadowing a big problem that banks could be in deep trouble in the months ahead. And it's not just Goldman. JP Morgan's earnings fell by 28% thanks to bad loan fears. Morgan Stanley's profit is down with their investment banking revenue collapsing by 55%. And this shows us the horrific environment financial institutions are in. No companies in their right mind are looking to IPO during a recession. You won't get a good valuation, the IPO price will be terrible, and demand just isn't there. But as Wall Street slips deeper into recession and massive layoffs are on the horizon, will this start a deadly contagion that will spread across the economy? Remember that back in 2008 and Lehman Brothers, the big banks were at the epicenter of the mortgage crisis, and guess who got bailed out? Wall Street, right? It was Main Street, people like you and I, who suffered and paid the price of losing their homes and higher inflation. And we're going to have to confront a profits recession very soon, and it seems to be led by the banking sector. Now, Bank of America's profits has tanked by over 30%, while Wells Fargo reports a horrific Q2 profit decline of 48% thanks to weakness in the mortgage market. Now, the financial industry as a whole is down over 20% year to date, and this is a very bad omen for the economy in the months to come. That is the problem with rising rates and high inflation, right? On one hand, companies are either afraid or unwilling to borrow money to grow their business, inflation is killing off consumer spending, and companies have to cut their fees to stay afloat. It's a stagflation storm where there's really nowhere to hide. And when banks are seeing their profits sink to the bottom of the oceans, they stop hiring, they cut compensation, and they start paying less to their vendors, right? Goldman has cut pay by around 30% since the start of the year, and now they realize, hey, wait a minute, we have a huge headcount that ballooned by 50% over the last few years, right? And that's a lot of people on the payroll. So even if we aren't in a recession yet, if the banks start slashing jobs and start letting go of their vendors, we are going to see a meteoric drop in both consumer and commercial spending. Money is going to become more scarce and liquidity is going to dry up. Now, obviously, the entire financial services industry is huge, comprising over 20% of the world's economy, and that's a frightening number. But if we just separate out the banking sector alone, we are still looking at a massive 14%. So just imagine if a slowdown happens to just the banks alone, there will be a horrific tsunami effect across every single sector connected to it. And almost every single thing we do, the companies we work in, the houses we buy, it's all connected to banking, right? We can't run away. And as we talked about weeks ago, Wall Street earnings estimate is still in la-la land. It's too optimistic. They're still expecting good results like the good old days, and that's being factored into stock prices, right? As you can see, just a month ago, they were still projecting earnings of the S&P to increase from $231 in 2022 to $254 in 2023. Even though we have the Fed's own data screaming negative growth for these 2 years, a recession that will start in 2022 and last till the end of 2023 at the very least. But guess what? Now analysts from the big banks are cutting their estimates. We have Bank of America predicting the S&P is going to crash further towards 3,600, another 5% drop or so. So Wall Street isn't always ahead of the curve. They aren't always the smartest guys in the room, or else they would have dodged the '08 housing crisis, right? They are becoming more and more reactionary and simply pricing in the bad news that has already happened. But understand that the economy isn't doing fantastic. The tech layoffs are getting worse, with companies no longer hiring and many firms cutting their headcount to try and conserve cash. And if this hits the banking sector, we could really see the economy start to go belly up. And the big problem fueling the destruction of financial services is the rate hikes. After the insane inflation numbers of 9.1%, the world is now bracing for big rate hikes in July to September. We are talking about possibly a historic 100 basis points move up in July and another 75 points in August and September, right? Which will just decimate the markets even further. Now, the rule of thumb states that higher interest rates are generally good for the banking industry. And we all know how they make money, right? They take your cash deposit, they loan it out for higher interest rates than what they give you back in return. And if interest rates go up, theoretically, they'll be making more profits on their loans, especially mortgage loans. Now, taking a look at the 30-year mortgage rates, we can see it crossed 5.5% in July and actually hit 6.2% at one point. That's more than double in just 18 months. Even the 15-year loans are at 4.7%, so Wall Street should be raking in the big bucks, right? But big banks' Q2 earnings are down thanks to mortgage incomes that seem to be declining, right? Take Wells Fargo for example, their mortgage banking income crashed by 79%, and we have JP Morgan laying off their mortgage division with hundreds of workers affected. Now, there are going to be more layoffs happening down the road, especially around the mortgage divisions. We just need to figure out who are the biggest mortgage lenders around, and those are the companies that are going to get clobbered real hard as rates continue to go up. We are seeing new housing starts drop by 14% and the home builder sentiment just cratering back to earth. People just aren't keen on buying homes anymore. Either they are priced out of making the deposit or the loans are just impossible to pay. And this is why we are seeing banks take a real beating, and this hammering is just going to continue down the road. And if you think this is only happening in the States, it's getting much worse globally. As the rate hikes continue, the dollar will become stronger and world currencies will start to depreciate even faster. And that means sooner or later, other countries will also hike their rates and cause further damage to the international banks. However, the stronger dollar isn't good news for the world or the US economy either. A stronger dollar eats up corporate earnings because it is now more expensive to buy American-made goods and services. We can see companies in the S&P 500 with more international exposure crash even harder than the domestic ones, as now the world has less money to buy products priced in US dollars, right? That's another big reason why some stocks are crashing harder than the rest, especially the big banks that have branches all over the world. Plus, you also can't rely only on local consumption back home. Inflation is at an all-time high. 9.1% is disgustingly high. And we all know that number is quite a myth, right? It's more like 20 to 30% easily. Just take a look at food and fuel prices. But at the moment, we have inflation at that level, and the last thing you want to think about is buying a new house with a liability that's only going to increase. You're already struggling to put food on the table and gas on the tank. And that is the reality of the world, right? And I think this is why all these Wall Street estimates are really missing. What is happening on the ground? What's happening on these streets day to day? And the higher inflation goes, the more the Fed is committed to fighting it, which means probably bigger rate hikes down the road. We are probably going to be hit with a 75 basis points hike in July at least. Now, the bigger worry is how much money consumers have left to spend, right? Because if banking layoffs are incoming, this means that spending and consumer sentiment is going to crater even further. Now, the University of Michigan has been tracking what consumers are feeling, and sentiment has never been more in the toilet. Consumer sentiment is at an all-time low, down 37% from a year ago, and the overall financial situation is approaching '08 crisis levels. But the most important part and the most interesting thing is what survey director Joanna Su has to say. She mentions buying conditions for durables adjusted upwards, owing both to consumers who cited easing supply constraints and those who believe that one should buy now to avoid future price increases, which would exacerbate inflation going forward. And this means that prices of essentials are probably going to increase down the road even further. People are stockpiling food, toiletries and consumables, and all these are getting bought up, and this is really funneling money away from investments and real estate. So what does this mean for banking stocks? Well, it definitely doesn't look good, especially as we continue moving towards a season of continuous rate hikes. And the big question is if Powell will go full Paul Volcker and hike as close as possible towards or above inflation. Now, if inflation continues to stay at 8 or 9% in the months to come, he will have no choice but to totally crush demand, because honestly, the supply side of the equation is out of his hands and it will take months or even years to resolve. Now, not all banks are in deep trouble, but definitely watch out for those stocks whose business is highly dependent on mortgages and loans, because even if they make a bigger margin per transaction, if the overall number of loans goes down enough, it can mean a net drop in revenue and profits, right? But I'm more concerned about you and me. I'm very concerned about our money in the banks, and if banks could really run into solvency issues, especially at a time when liquidity is getting pulled away. Just think back in the '08 crisis, it was only discovered when it was too late just how much toxic assets the big banks actually had. Lehman Brothers, for example, had a 750 billion balance sheet, but the assets were toxic and no one wanted to buy those trash, right? That was the underlying reason why the bank went bankrupt. Now, I'm not saying that money will disappear from your bank like in Henan, China today, but if there's even a 1% possibility of that happening, you really need to think ahead and prepare for it. And this is why it makes sense to hold some physical wealth outside of the financial system, like hard cash and gold. You have access to it, you can touch it, and if things really get hairy, you can immediately spend it to survive. But if you hate precious metals or you have issues holding hard cold cash, then at least spread your risk across multiple banks. Take advantage of your government's deposit insurance guarantee. In America, FDIC guarantees 250 grand per deposit per bank, and in Singapore, it's $75,000. So just spread around your risk across various banks, maybe 50 grand to Citibank, 50 grand to JPM. Don't keep all your eggs in one basket because bail-in laws are not myths. Bank can, in theory, dip their hands into your accounts and use it to make themselves solvent again. Because if any bank failure happens, I don't think any government will attempt a bailout in such a climate today. This will just make inflation even worse and people will be protesting on the streets again. So they probably just throw the big banks to the wolves. And this is the frustrating thing of today's economy. Everything is so interconnected that the moment one industry, one sector starts to shake, everything else suddenly becomes wobbly as well. Now, I think one of the few industries that are still up here to date is the war industries. Stocks like Lockheed Martin and Raytheon Technologies are still positive thanks to the war in Ukraine. Must I really hit to the dark side of the force to make money in 2022? I'm watching closely the retail sector, which might be the next domino to fall. So right now, consumer sentiment is circling the drain, but US retail sales somehow beat expectations in June, rising by 1%, so there seems to be quite a disconnect here. But if we dig deeper into the numbers, it seems that it's inflation that boosted the numbers. Accounting for the surge in prices, however, real consumption looks to be broadly stagnant in June. So now retail is on shaky ground, and I won't be surprised if it enters negative territory in July or August. All it takes is someone to sneeze for this house of cards to really collapse. I'm keeping an eye out on this number because if it starts to turn negative, then mainstream media will suddenly catch on and realize that, hey, maybe we are already in a recession. But whatever the case, it's important that we take steps to secure our wealth because things are gradually getting from bad to worse. All it takes is one spark to cause the entire economy to fall off a cliff, and it could be the banking sector leading this implosion. So let me know what you think. Do you see cracks in the financial systems, or are we all just hallucinating and everything is sunshine and rainbows? Let me know in the comments below. Stay safe and be sure to smash that like button, subscribe as we navigate through these turbulent times. Thank you all for watching and I'll see you soon.